Welcome back, guys. Today we're going to take a look at WIX.com. Now, I saw a super investor owned this stock, so I thought it would be a good idea to take a look at it. It is actually up 23% today because they reported earnings, and they were good because they actually reported like a pretty strong profit margin. So that's why it's up so much today. And over the past 5 years, it's up 21%. It went up like crazy during the cloud market, and then it had since come down. It would have been a great opportunity to buy in at this point. But now it's at $167 a share, and maybe it is overpriced, maybe not. Maybe it is a good chance to buy, especially after reporting good earnings. So let's take a look. They are a $9 billion company. I know they're headquartered in Israel as well, so I'm not quite sure if that has anything to do with maybe this drop in here with the war and stuff. But anyway, price to earnings ratio of 121. That's because they have slim profit margins right now because they spend a lot on marketing pretty much. And let's take a closer look here. Their revenue growth has been really, really good. They basically grew really solidly until they got basically bigger. So this is what normally happens. You can grow really fast when you're a small company, but once you get these high revenues, then it becomes harder and harder to grow. So this is what normally happens. It's okay. And last quarter, they grew by 12%, and they also were able to have a pretty decent profit margin as well. They made $24 million. But anyway, their gross margin is really nice. So basically, the cost of their goods are very low, but then they have to pay um, their research and development team, and then they've got their advertising, and looks like they cut their advertising cost last year, and their research and development has been pretty steady as well. So the idea is that if they can grow their revenues a lot, but then keep their expenses the same, then their profit margins are going to expand. And so I think that's a pretty compelling thing. Also, they have like a subscription based model, so a lot of people once they have a subscription, they're not likely to cancel it. So, well, I mean, they will cancel it if it gets really egregious, but most likely the revenue is just going to grow like for the most part indefinitely into the future. I don't really see a reason why the revenue would decline, but yeah, that's what I think. The balance sheet's fine. I mean, they've got 110 million in net debt. It's not too bad. In cash flow, their cash flow is much higher than their earnings because they must do a lot of stock-based compensation. They buy back some stock with whatever cash they have, and they pay off some debt. So fine capital allocation by management. In terms of stats, they they have negative return on invested capital, but that's just because they had negative profit margins, and the profit margin was 2% last year and 5% last quarter. So yeah, that's why the stock was up so much because they had good profit margins. They have, yeah. So this is their investor slides, and yeah, they've got creative subscription, creative subscriptions. So people subscribe to their platform, and so it's reoccurring revenue. Um, Very nice model, honestly. And there's a lot of things that they talk about here. Yeah, they have some business solutions, but they make most of their money from creative subscriptions, probably from like individuals or like small businesses. Um, Total bookings have been increasing. They've got this chart as well. The more recent cohorts make them more and more money apparently because they've got new products. That's good to see, and they've got efficient marketing. So each and every year, pretty much, the advertising has been getting more efficient. At least, wait, not quite sure why it's Q1 2020 cohort. Okay, maybe it's because It's because once they get a customer, they don't really make a lot of money on them until they keep paying into it over time. Then they see the return on their marketing cost. And then, yeah, pretty much all that. They've got broad demographics, so they make most of their money in North America, and then they make some money elsewhere in the world as well. Let's see what the analysts think on this stock. They think 4.84 in earnings per share. They're not going to be able to hit that. Yeah, so we're not even going to look at the earnings. We're going to be using revenue and margins model on this one. And they think it's going to be growing by 12% this year and then 13% into 2025. Let's check the stats, check the short percentage. Short percentage is 2.5%. That's not horrible. It's not a red flag. It's higher than some other stocks, but it's not too bad. Let's look at the DCF model I have on these guys. And so we're not using the earnings model. We're going to be using the revenue model with margins. And so I put the revenue estimate here. Buybacks is 0, net debt of 110 million, discount rate of 10% because I want the 10% return on all my stocks, and an exit multiple of 25. Now the reason I'm using 25 here is because it is a subscription-based model, and I don't really see their revenue growth ever declining, and it seems as though they're able to expand their margins each and every year, and I think that's going to continue pretty far into the future. So that's why I have their exit multiple quite high at 25. Next, their growth. So I use the analyst estimate here. They predict 13%, and then slowly declining from there. We already see this growth deceleration in their numbers, so I think this growth deceleration will continue, and the profit margin will probably be able to expand as they basically spend the same amount, but their revenue grows. So their profit margin should expand. Now, I do think that this is quite optimistic, honestly, that they're going to be able to get up to 18% margins. Yeah, I think that's quite optimistic. Last quarter, they had 5% margins, but that's just because it's a quarterly thing. So I think their profit margin this year is going to be 4%, and they're going to be able to slowly grow that over the years. Hopefully up to 18%, maybe not. And in this case, they are worth $150 a share. Currently overpriced at this moment. So I don't think I would be buying in at this moment. Also, there's definitely risks in this business because there's a lot of competition with other website creating tools. Like Wix is not the only one out there, and there's a lot of other really great ones. Also, I used Wix once, and I kind of felt like it was a scam because they charged a lot for it, and there's a lot of other ways you can make a website. You don't have to use tools like this. So yeah, it's interesting, but for me personally, I think I would stay away from it. But I don't think you're going to be like losing your money anytime soon in this stock. Maybe the stock goes back down to like $80, $90 a share. Not 80, 90, but maybe like $120 a share, and then maybe you could pick it up at that point. But yeah, I just don't think I don't think you're going to be seeing stellar returns with this moving forward. Because even if they hit this like pretty optimistic scenario where they get the profit margin up quite a bit, then it's still slightly overpriced. So yeah, that's what I think. Let me know what you guys think in the comments, and make sure to hit that like button, and I'll see you in the next video.